Hello and welcome to Personable, a podcast focused on speaking to the world's best, enabling you to become the best you can be. This is Monday, the 3rd of November, 2025, and we've got a range of topics today. Luke Sloman has become, a recurring guest in the podcast, in which, every week we break down the most important topics in markets and in the wider world. So, in terms of topics of discussion today, we've got Q3 earnings season, we've got a load of depreciation from AI investing companies. We've got the new BATMMAAN, if I'm saying that correctly, which is a new version of the Magnificent Seven. We've got some specific details on Nvidia. We've got the latest Fed cut, inflation, the US-China trade deal, and some more market outlooks. So getting started, we recently had earnings season. Going into some companies in particular, we've got Alphabet, Amazon, Apple, Microsoft, and Meta. Alphabet reported its first ever $100 billion quarter. Google Cloud revenue surged 34%, with AI search features increasing query volume, boosting the core business with a positive stock correction. Amazon smashed expectations with a $180.2 billion in revenue. AWS sales jumped 20%, which is the fastest growth in nearly 3 years as AI workloads boosted cloud demand, with the stock jumping more than 11%. Apple beat estimates with record September quarter revenue of $102.5 billion, guided for its best ever quarter for the holiday season, driven by iPhone 17 demand, but China sales remain a weak spot, with it down 3.5%. And Microsoft beat top and bottom line estimates with 18% revenue growth. Azure and other cloud services grew 40%, announced that capital expenditure will grow faster than ever in 2026. The stock reaction was slightly negative. And lastly, Meta beat revenue and EPS estimates with a strong 26% year-on-year revenue growth. However, the stock plunged 11 to 12% post-earnings. Luke, what are you what's your initial take to Q3 earnings coming out, both with those companies but also other companies that are starting to announce results?
Yeah, first of all, thank you for having me back on. But yeah, if we look across all of the major players in the S&P 500, Nasdaq, the companies that make up most of the weighting, obviously they've all had very good Q3s. And even just looking at the S&P 500 as a whole, 83% of companies beat EPS estimates, 79% beat revenue estimates. So overall, it's been a very strong quarter for all the players in the S&P 500. And that means that year-on-year earnings growth rate is now at 10.7% for Q3, up from an earlier 7.9%. And if this continues, it will make it the fourth straight quarter of double digits earning growth. So obviously, you said a lot of stats and numbers in your introductory speech there, but from essentially what's going on is it's been a very strong year, especially after the market shock from the tariffs in April. There's been a rebound, and we're seeing record highs almost every day now in not just the S&P 500 and Nasdaq, but just across the world as well. So these earnings just reflect how strong of a year it's been for these companies. Obviously, driven a lot by the tech industry and the main AI players such as Nvidia or Apple and Meta, all these massive organizations. But it's clear that that there's massive growth right now, and there's no expectation of it to slow down drastically in the next quarter or so. And I think it just shows how attractive the US market is right now for potential investors to invest in.
Yeah, I think one company in particular I think has been, despite the strong growth overall that's been kind of interesting, has been Meta, because going back to what I said a second ago, they beat revenue and EPS estimates with strong 26% year-on-year revenue growth, and yet the stock went down more than 10%. And so I thought I'd read you something interesting about it and then kind of focus down on 3 specific points why that happened. So the sharp negative reaction to Meta's earnings, despite strong revenue growth, signals a pivotal shift in investor focus. The market is moving from rewarding top-line growth to intensely scrutinizing the costs required to achieve it, particularly the massive capital expenditures, CapEx, for AI infrastructure. As tech giants enter year 3 or 4 of the AI spending boom, the accounting effects of depreciation are set to weigh heavily on the future earnings per share. Billions in CapEx are capitalized and the cost is spread over several years as spending accelerates. These annual depreciation charges from previous years accumulate and start to significantly impact the bottom line. So the three sort of specific points on that is there's more than 35 in capital expenditure costs. Obviously, Microsoft has invested in OpenAI, which despite the overall value of OpenAI doing pretty well, and we might potentially see an actual IPO listing in that in the next 1 to 2 years. So potentially this investment will come back to Microsoft quicker than they may have anticipated initially. But there's still 3.1 billion in a non-cash charge from its equity stake in OpenAI, which has reduced its net income and shaved off 41 cents of earnings per share. And lastly, even with the Azure growth forecast of 37% for the next quarter, some investors are still worried about limited proof of AI-driven productivity gains across the industry, drawing comparisons to past tech bubbles. So I think despite the underlying strong growth, I think there's kind of this weird thing, which we'll get into more detail on later in the podcast, where all of these businesses are reliant so heavily on all of the others. And I think Microsoft has been one of the big examples of that, particularly with its stake in OpenAI, and actually the cash hasn't been spent on that, but also the investment, in how accounting structures work hasn't actually gone down to the earnings per share yet. So that's kind of part of that reaction. Something else that I thought was quite interesting, I think it's pronounced the BATMMAAN. I'm going to call it Batman, but BATMMAAN, and that now accounts for 40% of the S&P 500 total market cap. So those companies are Broadcom, Apple, Tesla, Microsoft, Meta, Amazon, Alphabet, and Nvidia. This is the kind of new organization, and from the previous Magnificent Seven, with Broadcom actually having a bigger share in the S&P 500 than Tesla, which is pretty interesting. Adding on, major US industries posted gains for the final week of October 2025 and are set for their longest streak of monthly gains since January 2018. The strong performance was largely driven by positive reactions to earnings from Amazon and Apple, which helped offset concerns about rising capital expenditures that pressured Meta and Microsoft shares earlier this week. The S&P 500 climbed 1.4% for the week, closing near record highs. The Nasdaq rose roughly 1.9%, continuing its leadership role. The Dow Jones advanced about 1.1%, and the Russell 2000 posted a 2.1% gain. Since the low in April, the S&P 500 index is up 40%, while the Nasdaq has surged over 55%. One company that I think is particularly interesting, and I'll say this point and then we can get into deeper discussion about what I've just mentioned, is Nvidia. So Nvidia is obviously at the epicenter of the AI boom, and their performance continues to defy expectations, solidifying its role as the primary hardware supplier for the AI revolution. I would almost look back to Tesla a couple of years ago when it kept going up and up and up, but then investors were actually saying, hold on a minute, the earnings actually make sense for the growth that's being driven because they're actually delivering strong results. And a similar thing is happening with Nvidia. It's just kind of crazy when you're reaching a sort of $5 trillion market cap. So it'll be interesting to see what happened there. They briefly topped 5 trillion in market capitalization, exceeding the GDP of nations like India, Japan, and Germany. The Blackwell chip demand, the company confirmed it shipped more than 6 million Blackwell chips and has orders for another 14 million over the next 5 quarters. This order book represents approximately $500 billion in sales over the next 15 months. And lastly, strategic partnerships, which I mentioned just before. Nvidia has secured a vast and diverse client roster, including the US Department of Energy for building 7 new supercomputers, Uber for self-driving cars, Eli Lilly, Amazon, Foxconn, and Caterpillar. So, Luke, what are your thoughts, both on this new Magnificent Seven, being Batman, on the growth of the US industries, and also of Nvidia?
So, look, as I mentioned earlier, I think if you look at the S&P 500 now, it's heavily weighted, it's heavily top heavy now. Obviously, it always has been weighted towards the larger companies, but it seems that there are, as you said, the Batman companies that I think they account for nearly 40% of the S&P 500, right? So, from an investor point of view, even from someone just like me and yourself, who might be investing in funds and indexes instead of single stocks, just out of time, it does decrease diversification. You invest in the S&P 500 because you think, well, there's 500 companies. If one does bad, no problem. There's another 499. But when, 7, 8 stocks account for 40% of the of the index, it increases risk. And from an investment point of view, it does bring some worry for the future if there is, if we are in a so-called bubble that people say we are in. However, it also, shows just how well these companies have done and how well they've done this year, especially in the last couple quarters. And, going back again, similarly, you can see this with the earnings season, where all these massive companies saw, increasing revenue. They outperformed their expectations, and it shows how well this done. And you have to look no further than Nvidia, right? As you said, they've surpassed $5 trillion this week, and obviously first company in the world to ever reach this tally. I mean, I still remember when Apple surpassed $1 trillion. That wasn't even that long ago. It's pretty crazy how quick this growth has been in the last 5, 10 years, and how many companies are now breaching this threshold that which once people thought would never happen, right? Um, and for Nvidia is, I think their growth is just going to continue to go up and up and up. Um, it's it's probably the most talked about company in the world right now, the most topical. It's its market cap has just exploded in the last few years, and um, their revenues are up, as you said, $500 billion in revenue over the next 15 months is just an absurd number to even think about. Um, and it makes sense because analysts estimate that every gigawatt of AI data center capacity is worth $50 billion in revenue for Nvidia, which, and with the scale that they're growing in and with the scale of demand that is being grown, um, it suits Nvidia to just continue this trend of increasing, becoming more and more successful and becoming such the dominant player in the global markets. And again, with these partnerships with other tech firms, obviously I think last month, or well, I guess September now, they partnered with OpenAI as you know um, and other tech companies, Microsoft. It just means that um, they're partnering with these big players who require all this energy, all this AI data, and it's for them. It's a success story. You can't. There's no denying it. It's hard to see. There hasn't really been a move that they've done which has been critical or hasn't worked out, because it seems right now anyway, we might look back in hindsight and go, oh, maybe these partnerships weren't so great. But right now they look like they were, you know, masterminded. They've just grown into demand, and um, it just looks like they're setting themselves up for a very successful next couple of years.
I think the transition from the Magnificent Seven to now Batman is a very like interesting point, and it every single time that the Mag Seven gets brought up, or Batman as I like to call it, as a different, it's not the term, but we'll call it Batman just because it's easier to say.
Bit
Every
cooler
time,
as well, isn't it?
bit cooler, yeah. Every time there's kind of like new terminology like that, it always gets people to think, oh, all of this growth, is it bad that it's coming from these select companies? And there's, on the one hand, it's like, no, it's not a bad thing, right? You're making money, it's going up. You were talking about Apple just before reaching 1 trillion in market cap. Nvidia's 5x that to more than 5 trillion briefly. And so there's this kind of point of like, if you're winning, does it matter where it comes from? There's this often like analogy in sport, right? The coach will go on the drawing board and they'll kind of draw up the plan of, let's say it's football, so soccer, for example. You've got to get it to the striker. Luke's the centre mid. He's got to pass it up. That's how we're going to score goals, right? We're 2-0 down at half time. We need Luke to be like the kind of magic man and get it through to the striker every time. But if Luke goes and scores a hat trick, if Luke goes and scores 3 goals, I'm not going to be complaining, and I don't think the coach is going to be complaining either. So it's kind of that question of like, if you get the end result, does it matter how you got there? If you were to ask like long short hedge funds, for example, a lot of their goals would be, how can we get the most alpha, or how can we hit our target rate of alpha whilst also, maintaining a low beta, so a low like correlation to the market, but they also want to keep their risk down as much as possible. So just getting a pure earnings result isn't as good. If you were to ask the ordinary investor, where in terms of, for years, someone like Warren Buffett has been saying, go invest in the S&P 500, you can kind of get diversified stocks. It's gone up by X amount on average over the years. And I wonder for most people whether it's they just like the money in their pockets and they like it keep going up and it doesn't matter how it gets there, or whether actually having that diversified approach is the thing to do. I think also as kind of like human beings, 500 stocks is quite a lot to sort of focus on. I mean, even like hedge funds, right? They'll have people focused on tech, they'll have people focused on industrials, they'll have people focused on TMT, all of these different industries. So it's kind of like segmented, but the constant focus on it just being the Mag 7, BATMMAAN, or whatever it is, kind of gives investors this easier thing to think about. I mean, even looking at like the Goldman Sachs meme basket, meme coin, equities basket we were talking about a week or so ago, with the likes of like Palantir in it, for example, those have often outperformed the market. So we have to keep asking this question of like, if it works, is it the right thing to do? Stephen Roberts, a hedge fund manager I've had on this podcast quite a few times, and he talks to me about this quite a lot. And it's like, if you were to look back at the past 10 years and you were to wonder what were the right things to invest in, the answer would obviously have been the Mag 7, right? You could be like, oh yeah, I should diversify with this, and this. But actually from a pure earnings standpoint, where you're trying to earn your LPs, your clients, grow your investing base, whatever, the right thing to do would have been to invest in those companies, right? But the thing is, the problem, it's not really a problem, but the problem is that as these companies keep growing in market cap, can this thing stop? As Stephen was saying a couple of weeks ago, is what's kind of weird about this and why you might think it's a bubble, but why it might not be a bubble, it's kind of like another point of thinking, is if you look at Nvidia, we just talked about the amount of growth they're getting in the next 18 months, right? Over the next 5 quarters, how many people are going to go about buying their chips? You look at all of these different companies from Alphabet, Amazon, Apple, Microsoft, even Meta, right? They've got the earnings to back it up. I think it is just kind of these uncharted territories, which makes it really interesting. There's also this thing with Nvidia with the chips, right? That there aren't that many players who can actually go about producing chips at such a high level. So the whole global economy is going to go through these things. So on that one hand, maybe it's bubble, maybe it's overhyped. But if you're actually getting the earnings, if you're getting the increase in productivity, if it's actually increasing the amount of money that a business is making, then maybe this is just the new, this is the new direction. It's not just these small private companies that go and 10x or whatever it is. Maybe it happens on the public market side as well, because the level of productivity growth is going to be so high. The rebuttal I'd say to that, though, is that if we were to find out in the next 1 to 2 years, or even sooner, that there was a kind of stall in growth with regard to what AI capabilities can do, right? A lot of the information that they get from the sites of like Google, X, all of these different books and stuff on the planet. Sam Altman always sells this dream in which there's kind of like going to be more growth. We're seeing models beating math Olympiads and solving the hardest problems on the planet. If there was kind of a stunt in that growth, though, I think that fissure could lead to the overall market, and people would be like, oh, actually, you know what? Maybe this is a bit of a problem. And so I think that's something that we, definitely need to pay attention to. With regard to diversification, again, very like similar point to what you were saying. Again, I think investors have to think about, if it's making money, do we just leave it? Or do we want to diversify because we want to be exposed to lots of different things? I was speaking to a podcast I'm actually going to drop very soon with a man by the name of Yoshi Yokokawa, who is the CEO and co-founder of a company called Alpaca. They've raised more than $170 million, and they basically focus on creating like an API, so for people to build their own version of like Robinhood, say in a country like Japan, where it might only be available in the US. And he makes an interesting point that you can have diversification on the up. So, right, like, when all these companies are doing well, right, the S&P is going to go up by this amount, 15% or whatever this year, the FTSE's up 20%, the South Korean market's up 65%, whatever. But when it goes down, a lot of these markets are very correlated on the down. So, of course, ask yourself the question, how do you get the gains on the up? But if there's an inevitability in the market cycles that eventually it will go down, if they're all sort of correlated in terms of like equities, for example, across these different markets, then maybe diversification isn't a question. I think there has to be more insight for more ordinary, investors, less sophisticated investors. I think there needs to be more baskets or more opportunities for them to invest in sort of like things like the S&P 500. So, if you look at something like BlackRock or Blackstone, they have exposure to like infrastructure or real estate, or as I'm sure is coming up now, like more digital assets. So maybe they need that same level of like diversification in different baskets, and maybe equities as a particular sector, even that across different markets isn't diversified enough, particularly as if you listen to last week's podcast, companies like Nvidia with all this growth, Nvidia linking to the growth of like South Korea and Germany and the FTSE 100, all of the growth is still kind of coming from the exact same things. So that's kind of like the same questions we need to ask. The next point of discussion, as it's the October 2025 meeting, so 4 or 5 days ago now, the Federal Open Market Committee, the FMOC, cut the federal funds rate by 25 basis points to a target range of 3.75 to 4%. The decision was in line with market expectations and marked the second consecutive cut. The 10-2 vote revealed a split in the committee, with Governor Stephen Moran preferring a more aggressive 50 bits cut, while Kansas City Fed President Jeff Schmidt dissented in favor of holding rates steady. In a press conference, Chair Jerome Powell stated that a December rate cut is far from assured, citing strongly differing views from the committee. He used the analogy of slowing down while driving in the fog to describe making policy decisions without key economic data delayed by the government shutdown. The probability of a December rate cut by the markets fell from over 90% before the meeting to between 60 and 68% after. And with regard to quantitative tightening, the Fed announced it would conclude the reduction of its aggregate securities holding, quantitative tightening, on December 1st. So we were actually just talking about this before, Luke, where you were telling me about that after September we were expecting 2 cuts. We obviously had the cut, it was kind of like a 98% chance of it happening last week. Did happen, obviously. But then kind of, Jerome Powell kind of comes out of nowhere for a lot of people, more than 98%, 90% chance before dropping down to 65% of a second rate cut later in this year. Kind of hinted at it there, but why do you think that, Jerome Powell is no longer so confident in another rate cut for the end of the year?
Well, I think one of the biggest reasons is the government blackout, right? There's a lot of uncertainty as a result of the data blackout we've had over the last month. I mean, the government blackout's been going on for over a month now. Started 1st of October. Obviously, today it's the 3rd of November. So it's been going on for over a month, and this lack of data over, of what occurred in October has meant that there's more uncertainty, more volatility. There's less visibility of what's going on, and it's the combination of that just means that the margin of error for the Fed grows if they decide to decrease rates again next in December. So I think that's one of the reasons why Jerome Powell signaled that they might just keep it at what it is currently, 3.75 to 4% range. With the lack of potential December interest cuts, there's also going to be it also means that for markets which were expecting more aggressive easing, will have to recalibrate a bit, and there was a bit of a reaction in the market after he said that. But this has been quite a big week financially. So as we were talking about earlier, there was a lot of earnings which came out. So the markets were also reacting, up and down compared to what happened in the earnings season. So I think for investors in the US market, S&P 500, Nasdaq, whatever, there shouldn't be too much of an issue. And there are still expected reductions in the interest rate next year, early next year. Anyway, as we all know, Donald Trump has been very vocal about reducing interest rates all throughout his presidency. As a result of the national debt that they have incurred over the past 30, 40 years. We've seen him being at odds with Jerome Powell. I think he said some harsh words over him last week on Tuesday, I believe. That's the general trend that's been going on over the last year, because, well, of course, interest rates have been cut a couple times now this year. It's still not at the pace that Donald Trump wants it to be. But either way, there are high expectations of interest rate cuts being occurring in early 2026. Um, and I think, yeah, it's nothing to be worried about. It's just a slight delay. That's all.
Yeah, I actually think it's a very interesting point with regard to the overall impact of a government shutdown and the wider implications of that. Because something that's very interesting from a government level, right, where you've got a couple hundred people making a decision on we agree with XYZ, we don't agree with XYZ, and what decisions will come of it. That's kind of like the simplified way of it happening. But I think when you're reaching a point in which it's kind of been how many days has it been of the government shutdown, Luke?
Well, it was started on the 1st of October, so 33 days, 34 days.
33 days, right? 33 days of people not getting paid, 33 days of delayed figures on unemployment, on inflation, on how the economy is doing. So many different important things in the US are reliant on the government working properly. And the very fact that it has such big implications. There is a question, right, on a podcast like this, which is focused on pure markets. You might ask, all right, what is the exact focus of why discuss the government shutdown, the philosophical parts of it? Well, it's because if there's no decision made there, the productivity decrease throughout the US is just so big, right? Markets have way less, confirmation in terms of what's going on, right? If you don't actually have the figures, markets will often move in real time depending on what figures are announced. So if those are being delayed, the market might not actually be as accurate as before. So if you're making a rational assumption that Apple is undervalued, for example, and you're making that bet, but then a load of figures come out that unemployment is way higher than it previously thought it to be, and also that inflation was higher than you thought it previously to be. Those macroeconomic conditions will impact that specific company, even if you have the right thesis and even if you thought Apple was going to do well. So particularly if you're a point of like investing in the shorter term or even using something like leverage, that could be particularly dangerous. I wanted to announce or mention some other like key data that's been announced, and then go into more detail on the US-China trade deal, some more market outlooks, and then also the UK. So in terms of the September CPI report, it was released after a delay and it came in at 3% annually, slightly better than the 3.1% expected. However, this marks a steady rise from the 2.3% low seen in April. Q3 GDP growth was stronger than expected, with a 2.8%, highlighting economic resilience. And the University of Michigan Consumer Sentiment Index fell for the fourth consecutive quarter to 53.6, which is its lowest level in 6 months, indicating anxiety about inflation and job security. So a big one that we spoke about last week was the US-China trade deal. So Trump has met with Xi Jinping, and this was kind of seen as one of the most important meetings of the year. You obviously have the two biggest economies in the world, US being more than 30 billion, for 30 trillion, 30 billion would be quite small for the whole US, and also 18 trillion for China. So, big implications for the rest of the world. And there were a lot of expectations for it, right? China had a pause on buying things from farmers in the US. At the same time, we kind of had the rare earths that the US needed from China. 93%, or I think it's 93%, correct me on that if I'm wrong, of the rare earths actually go through China. And these go, from making things like AirPods to making weapons and machinery, to many like advanced pieces of technology need these kind of rare earths, much of which the US economy, particularly AI, right? AI relies a lot on rare earths. So that was another big point of discussion. There was also the likes of like Taiwan and kind of like military safety and how they interact with each other. But I think, and also TikTok, but I think, it was kind of like the agricultural deal, rare earths, Taiwan, TikTok, and fentanyl. So that was kind of what wanted to happen before. Now, which I'll read through, we've kind of got some pauses and some things kind of being reenacted or, unpaused. But there hasn't been a kind of major deal yet, which is kind of supposed to be announced in the next 24 to 48 hours. So next week's market podcast, we can go into more detail on it. So the US has agreed to cut the 20% fentanyl tariff on Chinese goods in half to now 10%, lower the average tariff on China from 57% to 47%, and also a pause to add more Chinese companies on the export blacklist. Also, possibly to help Nvidia sell chips to China, because this has massively decreased over the last few years. I think it got to zero at some point. China has agreed to buy 12 million tons of US soybeans in November to December 2025, and also buy 25 million tons of other US farm goods in 2026, going back to 2024 levels. It's going to stop blocking exports of rare earths, magnets, gallium, germanium, antimony, and graphite. It's also going to issue export licenses for these materials until November 2026. And also the US is going to stop investigating US chip companies in China. Both sides will work to reduce fentanyl chemicals flowing into the US. The US may remove fentanyl tariffs completely if China keeps its promises. There are core issues such as IP theft, tech transfer, and market access are not being solved. And there are more talks planned following. We'll see what deal happens in the next few days. After, with another meeting for Trump and Xi in April 2026. The bottom line is a temporary pause to stop the trade war is to stop it from getting worse. This will help US farmers and tech supply chains, but prices will stay high for Americans, approximately $1,300 a year per household. So I think it's obviously a big win, or a win for weapons manufacturers, for tech giants like Apple, for car manufacturers, people trying to producing cars like Tesla kind of keeps the fabric of the US economy to continue going. Nvidia, of course, helping them to keep expanding. TikTok is going to be an interesting point of discussion if that's fully allowed to go through. I think for Trump has been a president kind of showing himself as a man of the people, trying to bring back the kind of working middle class in America, both raising the amount of money that they can earn, bringing back jobs, trying to reindustrialize America. And I think it kind of like a similar adjacent point to that, I think, is the US farmers. And when China stopped buying so many soybeans from the US, that led to might not have been seen by the average stock investor, but I think boots on the ground, for a lot of farmers, this was a very difficult time, with China being one of the main importers of US soybeans, as an example. What was that? That was 12 million tons of US soybeans. You can imagine the amount of people employed by that. And then on top of that, another 25 tons of US farm goods. So there isn't, trade war, but also finding a way to sort of interact with each other. Luke, what do you make of that? The fentanyl tariffs, the farmers, the chips. Do you think both sides got what they wanted? How do you think the US and China will continue to interact over the years? Do you think it'll be more friend or foe? And any other interesting points of discussion on that?
I think for the next 3 years, especially, it'll be more foe. Especially under the Trump administration. It's obviously we've all seen what he's done so far this year. He's put some tariffs. It's a bit more of a protectionist policy. Um, so I think we won't see free trade in full blossom under his administration. Obviously, after that, who knows? But I think at least this framework deal that occurred last week, and the deal that will occur hopefully in the next 48 hours. It's obviously it's very successful. It's very good for both sides. It reduces prices for some on certain goods, for both Chinese people and American people. Looking at soybeans, for example, a lot of that's a lot of farmers, a lot of farmers who probably aren't, getting making the, having the highest standard of living, especially under what was occurring beforehand, where the Chinese would stop purchasing US soybeans. That they're all of a sudden going to have a much better time in this market, and they're going to have they're going to make more revenue. They're going to have a better standard of living, and it comes at a time where unemployment in the US is high, comparatively, relatively to their history, and job growth is slow. So it's not as if that these farmers had the options to change profession. So I think it's come at a very good time for them. Obviously, just going back to earlier's point of the blackout of the black shutdown. That's also, in addition to that, that's increased. Essentially, all these government workers are currently unemployed. Obviously they have jobs to go back to, but they're not on. They don't have work to do. They're not earning any money. So I think it's key that that Donald Trump focuses on areas in this framework that will reduce unemployment and help the American people out. Especially a lot of these people are probably Trump voters. If you think about the general population, a rural population, so it for a you know candidacy point of view, like he would definitely want to help these people out to regain that. Well, obviously he won't run for presidency, but to keep them as Republican supporters. Um, Also, I heard with Nvidia there was talks that Trump would um bring them up in the conversation with Xi Jinping, um and that obviously that would be great. We were talking about this earlier, but they've unbelievable company. They've increased the market caps increased substantially. Their revenues increasing substantially, and that's all without really competing in the Chinese market. If all of a sudden they can get access to the second largest population in the world, um, 1.4 billion people, that's going to be incredible. That's just, they get an access to a seventh of the world, which is such a large, potential market to enter. Obviously, China has their own AI GPU, industries and tech companies, and it may still be a very tough task to get into this market, but just the option of having access to it is will be a massive boost. And if if they were able to, to set up camp in China over the next couple of years, I think if I was an Nvidia executive, I'll be licking my lips at it. There's so much potential. There's so much potential there, and
Heard it here
um,
first. Luke Sloman will be licking his lips at out in China.
if I was an Nvidia executive, not in general, but yeah,
I want a clip of that when that happens.
you want a clip of me licking my lips when, but
Yeah.
again, I'm not an Nvidia executive. So if I ever become an Nvidia executive and for some reason the Nvidia haven't got access to the Chinese market, and uh, while I'm there, they get access to Chinese market, I'll guarantee that Personable can get an exclusive clip of me licking my lips. I said it. There you go.
I
Um,
wonder how that comment is going to change markets today. After hearing the personal markets episode, Luke Sloman going to lick his lips in 30, 40 years time and have enabled access.
well, that just shows you have to stay subscribed and put
Yeah,
the
you have to
notification
stay
on.
subscribed, right?
You have
Like
to stay
even if
subscribed.
you have to stay subscribed through the years. I wanted to go on.
Yeah, but obviously, going back to some more serious matters. Um, the rare earth deal and critical minerals are massive boost for the US. As you said, I think China supplies 70% of global rare earth mining and 93% of magnet manufacturing. So we're talking about very substantial numbers. There's no other country who supplies rare earth minerals like China, and you know, with them being such a key component in technology and AI parts, it's not a country where you want to have as an enemy, especially when the biggest tech firms in the world are American. And for Nvidia, this would be great news. Well, not just Nvidia, but all these tech firms, it would be great news because it means that there's not going to be a increase in tariffs on these critical minerals that will increase costs and decrease profit for these companies. Um, and look, obviously, you saw with the US signing deals with Australia, for example, of trying to diversify their supply range, and I'm sure that will continue to occur. But you know, again, they supply 70% of global mineral. It's hard to look past that. And any deal that occurs in the next couple of days, I'm I'm sure of it will include a provision on of something along the lines of not having tariffs or having minimal tariffs on these global rare earth minerals and going forward.
There's a very interesting thing that I've noticed about human psychology with regard to the markets. You know, there's this like index I think that CNBC do with regard to like greed to kind of fear and looking at like how people are investing their money, depending on like how people are kind of like emotionally feeling, and I'm sure they have, you can look at CNBC to kind of work out how they go about doing that. But something that's kind of been a big topic of the discussion in the past 2 to 3 years, I mean, even like in COVID, right, there was a big expectation that we were going to go into a recession. And I think we did actually go into recession for a tiny bit in the UK, but there was never like any 2008 financial crisis level of drop. And I would say since then, particularly if you look at like 2022, with the sort of like drop off in cryptocurrencies, NFTs, the metaverse, Facebook changed its name to Meta and everything that happened there. And even now, as the market continues to do well, there is sort of like an innate human psychological element to which people are like, when's the crash going to happen, right? What is it going to be in? What's it going to look like? I actually had a fascinating point from someone the other day. It was like, if you look at the 2008 financial crisis, of course, as a result of what happened, the wider market was impacted, and it kind of impacted everything in financial markets, right? But it actually started out with the subprime loans, started out in the housing market, right? And I think because we're constantly seeing so much growth in the Magnificent Seven, now the BATMMAAN, right? I think there is the expectation, and now with AI, right? I think there is the expectation from a lot of people that if there was to be a crash, that all of that growth and, all of that, negativity would impact those particular companies. What they were saying is, that's not necessarily the case, right? Of course, as a secondary consequence, that might happen. But I think the market, and at least how I hear retail investors describing it, I think so many people are so fixated on this company's doing really well, so therefore, if there is a crash, that company must do badly in the future. When I actually think that's the wrong question to ask. I think it's less about what are the companies that are going to do badly just because they're valued higher, but more so a question of what are the sectors and industries that won't do as well because they're being artificially propped up by a bubble. And as Stephen Roberts talked about a couple of weeks ago on the podcast, he doesn't personally believe that the Magnificent Seven, looking at them, were in a bubble because of the strong amount of earnings that are happening on account of that, right? So I think it's less about, the valuations and more about where are the earnings coming from? Is it the whole market? Is it a particular sector? And what's going on there? Something I like to do, as you've noticed, people have started to notice those listening in these markets podcasts, is obviously being someone that's not an institutional investor, right? Like it's not like I'm in a bank right now day to day, nor is Luke. The hedge fund managers obviously have, what they're seeing, but it's not like they're in a, on the sell side hearing from all the hedge fund managers of what's going on a day-to-day basis. And even they don't have complete information on what's going to go on in the future. But what I'm kind of seeing from retail investors who are kind of having a bigger stake in the future is, despite all the negativity around the news, right? All this like market crash, overvaluations, all of these like, small group of companies continuing to drive the earning, continuing to drive the increases in market capitalizations. As I mentioned earlier in the podcast, and I mentioned last week as well, the Goldman Sachs meme stock basket is still doing incredibly well, right? So you kind of have these two contradicting ideas in which people think that there's a market crash coming, but at the same time, people are still, kind of doing the reverse of that and putting a load of money in companies which don't necessarily have the fundamentals and are doing really well. So I took 4 stories from YouTube, from Everything Money with Jason Furman, with Andrew Sliman from Morgan Stanley, the Michael Cohen channel, and also a talk with Howard Marks of Oaktree Capital. And I wanted to just give their different ideas of kind of what's going on in the markets right now. So the Everything Money channel with Yale economist Jamin Furman, it cites the Shiller-Cape ratio at 40.58 and the Buffett indicator at 126% overvalued. AI-related firms have driven 75% of S&P 500 growth since late 2022. The core idea is that the market is in a speculative frenzy fueled by AI hype that far outpaces profitability. Similar to the dot-com bubble, a severe crash is inevitable, according to them. They prepare for a crash by having a watch list of high-quality companies to buy at stupid cheap prices, dollar-cost average into low-cost ETFs to welcome the downturn as a buying opportunity. Andrew Sliman of Morgan Stanley notes increased speculation into non-profitable tech, argues the bull market started in October 2022 and this late stage could last for years, similar to late 1990s. The market is showing signs of late cycle euphoria, but strong earnings from tech leaders provide fundamental support. The biggest risk is an overly dovish Fed inflating the bubble faster. Do not bet against the market. Stay concentrated in dominant big tech companies that are reporting they can't keep up with demand. Thirdly, the Michael Cohen channel cites a 97%, have to fact check this, but he cites a 97% decline in the USD's purchasing power since 1913, rapidly expanding M2 money supply and massive central bank gold buying. The real crisis is not in overvalued stocks, but a devaluing dollar. A fiat currency bubble is forcing all asset prices higher in nominal terms to preserve wealth. A market melt-up is more likely than a crash. Focus on acquiring real money in hard assets like gold, silver, and some cryptocurrencies. Cut expenses, pay off high-interest debt, and build an emergency fund before investing. And lastly, with a talk with Howard Marks of Oaktree Capital, acknowledges the market is expensive and frothy, but is not yet in a state of mania. Notes the difficulty for value investors to find opportunities. The market is overvalued, but the leading companies are exceptional businesses. It is a risky and frustrating environment where a correction is possible but not imminent. Consider more defensive assets. Corporate bonds and other credit instruments offer a contractual guarantee approaches something in the sixes and are more defensive than equities at elevated valuations. So if there's any big takeaway from those 4 different points, is some people think that we're at the late stage of the cycle. Some people think a crash is imminent. Some people don't think so at all. Some people use the valuations of the Buffett indicator and the CAPE ratio. Others point back to the 1990s, 1990s prior to the dot-com bubble. Other people cite that it's actually a thing that's going on for 120 years, pointing back to the purchasing power of the US dollar in 1913 compared to today. Others will talk about, you have to focus on more defensive stocks. So these are many of the greatest investors on the planet. And even though, some of them are saying could be more growth for years to come, some are saying a crash is imminent. The point is to say that you need to kind of take in as much information from as many different sources as possible, work out who you trust the most, but also understand that even the most legendary investors on the planet do not have a guaranteed amount of knowledge or information to be able to say this is definitively what's going to happen. A stat that I often like to quote is that within 5 years, 60% of hedge funds fail. So I think there's kind of like a presumption that if someone was to go and raise capital from outside investors and go about starting a hedge fund, that they would have some form of superior knowledge, right? Maybe they got an Ivy League degree, an MBA, worked at one of the top banks on the planet, got experience working at one of the top hedge funds on the planet, and then go about starting their own one, right? And 60% of those are failing, right? So if that is if these are the smartest people on the planet failing, right? It's not to say, it's improbable to get things right. Obviously, there are people like Citadel and Millennium, Beliasny and Point72 that get consistent returns over time. But it's if these are all the public areas of knowledge, right? All saying there's going to be a crash or there's not going to be a crash or whatever. I think you need to have more areas of interest, right? Is a market crash coming? But yet retail investors who have a bigger impact on the overall markets now are also still investing a ton of into companies. Do you look at companies based on the fundamentals, or do you look at it from the growth story? If you were to look on a pure earnings basis and go back 5-10 years, you look at even a company like GameStop, right, which did extraordinarily well after the short squeeze. Is that a successful trade, or do things have to align with fundamentals and do well? Do the earnings matter from a pure basis of how well it does, or do you need to have a low amount of risk? And I think when you've got so many hedge funds, you've got market makers, you've got hedge funds using quantitative analysis, you've got a huge uptick in retail investors, and also in the broader market, a lot more people betting and also using prediction markets. So there's so much money in the market right now. So I think it's have to discover, all right, do I think a crash is coming? Yes or no? How long do I think it's going to take? Am I going to have an amount of money saved and then invest? Am I not going to? These are a lot of the questions that I like to think about over the next few months. And I think it's important to have those differing perspectives, because I don't think it's fair to just simply look at headlines and say a market crash is coming or isn't coming. I think the nuance is important. Luke, do you have any thoughts on my spiel on all of those different things there?
I mean, I think it just shows how, even as you said, even the top hedge fund top hedge fund managers, even the top investors of the world they don't actually know what's really going on. You've got so many different opinions, so many different things being thrown out there into the public domain that if you're I'm sure a lot of early investors, who are just trying to get into investing, will be very confused with what to do and with what to invest in. If people are saying that a bubble's gonna pop imminently or market crash gonna occur imminently, compared to other people saying, "Oh no, this is fine. This is just the start of a massive boom." Your investing strategy is obviously going to be very different. Um, I think, yes, as you said, I think it's very important to work out who to trust online because so many people anyone with a camera and a mic can go on YouTube and film a video saying, "Oh, invest in this right now." I'm sure if you search up, if you go on YouTube right now and to an investing video, you'll see so many clickbaity videos which is saying these are the five best stocks to invest in 2025 or five best stocks to invest in 2026 and beyond. And it's this lack of information, this lack of without having a person who you trust, it can be quite overwhelming. Um, and like even for me, obviously, I've got some money invested without going into too much detail. I have some money invested in S&P 500, for example. It's like I have to think about my as well. Like, oh, do I want to keep putting money in there, or do I want to diversify my product a bit? Because diversify my portfolio a bit, sorry. Because I think going back to what we were talking about right at the start, and Batman and the Magnificent Seven, it's these funds are actually not that diversified anymore. So if we were in a bubble and the start of a bubble, then I might be thinking, oh wow, actually, I want to shift that money away. But again, if we're in a boom, my thought process would be, yeah, okay, let's keep buying more and more shares of the S&P 500 because it will only benefit me, right? So I think long story short, I think it's very important to work out who to trust and also have to take a pinch of salt with what these people are saying because yes, these people have been very successful previously, but there's no past history has nothing to do with the current, right? It's not if these investors beat the crash in 2008, for example, doesn't guarantee they're going to beat the next crash if there is going to be one in the next couple of years. So you have to, I think, in the end, there you have to make your own decisions, and but with the information that you're provided with, you have to really trust the person you're listening to because if you're investing money, no one wants to lose money, right? And whether that be just $100 or hundreds of thousands of dollars. So it's I think yeah, it's a good time for people to be informed and even if you're an early investor, make sure that you're very happy with the choices you're making.
I got 3 points in response to that. One, with regard to what I was talking about before, with regard to where the specific crash would happen, if it happened. And a thought that I had a while back was there's so many AI companies that are getting incredibly high valuations, but they're kind of just built as a tool on top of the OpenAI platform, right? Like you see so many platforms that the actual information is not different, but there's kind of like a series of queries or chats or requests or prompts, as people call them, that have been put into chat on their own interface that then enables them to rebrand it as their own business. And you see companies like Lovable, which I think is more than a $1 or maybe $2 billion valuation. And people are kind of like, all right, that's here to stay. They offer a unique perspective. They are enabling people to code using the backdrop of ChatGPT, but they have their own unique modeling on top, which ChatGPT and OpenAI can't replicate. It's obviously a unicorn, right? They're not going to try and knock that down. Then on the other hand, we recently announced the OpenAI, well, ChatGPT App Store. So they actually went about, allowing people to host their platforms on OpenAI. But then you also see OpenAI, for example, adding on, an agent onto ChatGPT, so it can actually do some of your tasks for you or put in apps into ChatGPT. And I saw a tweet, an X post yesterday, and it was basically saying that like be careful what platforms you put on OpenAI, because if OpenAI has this kind of thing now where it's worth more than $500 billion, they're looking at doing a more than $1 trillion IPO in the next 2 years, 2026 or 2027. They're going to have to keep trying to get more revenue, right? They have to actually like have good books, right? And so there's kind of this thing that potentially OpenAI, there's no contract preventing it, will look at what are the most profitable companies on our platform and how can we replicate that. I mean, you see it with Amazon, right? There's been various court cases over the years in which Amazon will look at what are the most profitable, things, tools, products, consumer items on our platform. Let's make them Amazon Essentials, and let's also change the search criteria, the SEO, so that Amazon Essential goods come to the top. Like they control the platforms, they can put themselves in the top. You see the same thing with the Apple App Store. Fortnite, an app that you and I both like, or you used to like it, still like Fortnite. They had a big argument with Epic Games a few years ago because Apple were taking 40% commission on, or some amount of commission on the amount of fees that were spent on the App Store, and Epic Games started to get their fees just off Google or getting it off the internet. They basically fell out, got removed from the App Store because they didn't have that agreement, right? If you own the platform and you own the interface, you can kick people off. The reason I mention that is with regard to a crash, there's been various mini crashes over the past couple of weeks and months as OpenAI have continued to develop, continue to become this like insanely massive thing, but also have knocked out a ton of startups along the way. So if you look at the 2000 tech bubble in which a ton of companies failed, but then other companies succeeded, a lot of those companies failing, in that instance, it may have been a kind of sudden thing, and then one of the big ones sort of failed, quite a few followed on from that. But if you're looking at right now, if you're looking at the startup world, for example, a lot of those companies kind of already failed or are continuing to fail. It's not like there are companies getting sky-high AI valuations, but a lot of those companies have already failed or have already been replaced. So it's not this kind of like infinite thing. The second thing, you look at one of the biggest faces in finance, Jamie Dimon, right? The CEO of JP Morgan, helped build it up to the biggest bank on the planet. He, a few years ago, said he didn't like cryptocurrencies. And now, at the FII summit, or F11, I think it's the FII summit in Saudi Arabia a couple of days ago, he was asked a question, do you believe in cryptocurrency? And he's like, yeah, it's the future. So you kind of see these major figures going from, not think it's a good idea to a good idea. So maybe you had the same thing with the market. Another thing, which kind of pissed me off a little bit, a couple of weeks ago, I told you about a podcast, the All In podcast. So 4 of like the best venture capitalists on the planet kind of host this podcast, and they had an All In summit. Right, so they kind of had this in-person event, and they invited some of the smartest people on the planet, from Elon Musk to CEO and founder of Palantir to the managing partner at Sequoia Capital. And I said to you on the podcast, I was like, here we have the managing partner of Sequoia Capital, and he's saying there are way more inflows of venture capital, way more people want to invest in venture capital for the amount of returns that can happen. Like if you look at it over the years, there's maybe like 20 portfolio returners in a year, the likes of like Airbnb, DoorDash, etc. So for venture capital investing, you often have one company that will basically return the whole fund. And if you look at the overall market, the number of them have been very small. But he's basically saying there's too much money. But then, somewhat ironically, in the last couple of weeks, he's gone and raised a new $750 million fund. So if there's any big takeaways to take from this, it's essentially to say, of course, listen to the people at the top, but think about, do they have your best interests at heart? Are they investing your money or other people's? Are they saying the right thing because it's what they think, or are they saying the right thing because it benefits, in VC, for example, it benefits them if there's less money around because then there's less competition, more ability to get deals. You have more VCs popping up which are taking deals from the likes of Sequoia and Andreessen Horowitz, so it's in their benefit that other funds don't exist. But then to say, don't invest, there's too much money, and then instead of using their existing capital to go and raise another $750 million fund, don't raise money unless it's me. I think that's kind of ironic. What's your take on that fund point, Luke, the Sequoia point?
Yeah, it's quite interesting. Obviously, I don't know. I think it must have been planned out to some certain extent, right? Because you're not going to say something like that and then backtrack it 2-3 weeks later. Also, it takes time to raise money, so it's not like he would have done it spontaneously in a day, right? You're not raising 700. Was it million or billion? million,
Yeah,
obviously.
million.
Yeah, yeah, of course. You're not raising $700 million in one night. So, so it's quite interesting how he said that because obviously that 700 million was being raised when that comment came out. And I think again, as you said, a bit hypocritical. Um, Probably doesn't have the best interest of the viewers at heart. And I think the biggest takeaway from that is instead of watching, those podcasts, everyone should just watch Personal instead, where we have the best interest of the viewers at heart. You can clip that. So yeah, but no, yeah, it is very hypocritical, and it's like I think a couple of years ago, Jamie Dimon, I can't remember the specifics of it, but Jamie Dimon said something. He said something about a certain stock or maybe it was crypto or I can't remember the specifics, but which caused and I think he didn't own it, but it caused that stock to plummet, to share price to come down, and then
Yeah.
he bought the stock the next day or the week later when it was cheaper. So these people know they've got massive voices. They know they've got millions of people who will listen to what they say and will act on what they say. And sometimes that loyalty can be um, twisted a bit and used for their own advantage. So I think whenever you listen to these big CEOs, hedge fund managers, um, again, like what we were talking about earlier with investing tips, you just have to be careful. You gotta know who you trust, and in the end, it's down to your judgment. So yeah, you just have to take everything with a pinch of salt.
I think one of the big things right now in terms of where to get the alpha of the future, right? You look at public markets, right? You look at the S&P 500, 40% of those stocks are the BATMMAAN or whatever we're going to call it. B for short, we'll just call it B, just Broadcom. Maybe that will, stock goes up 50% after the Personable Markets podcast. That. But then you're looking at private markets and, you know, if you hear, right, you're hearing it from the managing partner of Sequoia. It's too much money coming to venture capital. He's in that game. He's made a ton of money. Got one of the most successful funds of all time. Doesn't want that, right? But if you're seeing a stat, right, that billions upon billions upon billions are going into venture capital, into private markets, maybe that might make you think that is the place that we're going to get the returns in the future. And for the retail investor, there have been market makers like Citadel Securities, like Jane Street, etc. They've basically got the costs of trading, the commission cost of trading down to 0%. So in terms of the actual spread, there's no like fees that they're paying, right? So there's also a thing of like, is there more money in the markets, not only because the market's doing better, but because it's easier to invest? There's more money to invest, kind of off the COVID pandemic, more money was printed than ever. The amount of quantitative easing, there was so much money to be spent. And a lot of that money from, the less financially literate would go in the form of, as inflation was higher, in the form of higher prices, subscriptions for the likes of Netflix, go into the earnings of those companies, increase the market cap of those companies because of there's obviously an earnings, like a multiple on top of that. So that money then goes back into those, the wealthy people or wealthy funds, which then gets reinvested. So it's kind of like this self-fulfilling cycle. It's the question of, is private markets the better place to invest versus public? Because, a lot of inflows into private markets, but also into public. But if you were listening to this and you weren't part of a fund, it's actually quite hard to invest in private markets unless you have a direct, access to the likes of something like Sequoia. I want to finish with one main topic, that being the United Kingdom, where both of us are from. The UK's been, kind of got the short end of the stick in terms of like commentary the last couple of years. You see its big brother, the USA, doing unbelievably well. You see Trump and Keir Starmer meeting and kind of memes and being made out of Keir Starmer because, Trump has kind of just acted however he wants around him. But I saw an interesting stat today from the IMF saying that the UK is set to be the second fastest growing of the world's most advanced economy this year. And that's from the International Monetary Fund. They also predict that the UK will face the highest rate of inflation among G7 nations this year and next, driven by rising energy and utility bills. I thought that was quite surprising that it was the second highest. I thought that, as all the negativity around the UK, it might be lower. I kind of wanted to list off some expected changes before the autumn budget in a couple of weeks' time. We can kind of compare how we did comparatively. So, in order to plug the £36 billion tax hole that we have right now, they're expecting a freeze on income tax and extending the freeze on income tax and national insurance thresholds set to the end of 2028, which could raise £12 billion as wages push more people into higher tax bands. Reforms to limited liability partnerships, requiring them to pay employers national insurance, potentially generating £2 billion with a broader tax raid on partnerships, for example, on lawyers, accountants, and doctors, expected to add £1.9 billion. A possible 1p increase to the basic income tax rate, alongside adjustments to higher rates, which could break Labour's manifesto pledges. Property tax overhauls, such as replacing stamp duty with a new property tax, increasing levies on landlords, reforming council tax, or applying capital gains tax to some main home sales, reducing the cash ISA limit from £20,000 to £10,000, though experts warn this could harm savers without boosting stock markets, higher taxes on banks, online gaming companies, and a 20% setting up charge on assets for people leaving the UK, potentially raising £2 billion to align with G7 norms. Closing a tax loophole for small parcels under £135 to level the playing field for UK retailers against foreign online sellers. And lastly, potential surtax on business rates, which supermarkets warn could drive up food prices and household costs. Sounds like, I feel like I'm a kid in a candy store, and like any piece of money that you have just going to get taken by the UK government. How do you feel about the potential autumn budget, Luke? Do you think it's a good thing, a bad thing? Obviously, this deficit has to be filled. The founder of Revolut, he left a couple of weeks ago to Dubai. With Revolut going public, that would have raised potentially $9 billion for the UK government, but obviously he's left, so maybe that's potentially why they're adding in the tax on total assets. 20% seems like quite a lot to the UK. Do you think it's a good thing, bad thing? If they didn't, have these taxes, where would they get the money from? What do you think about the Labour government's, potential approach to filling the $36 billion loophole?
But look, there's no denying that Labour government do find themselves in a very tricky situation here, because they have to get rid of this £36 billion loophole, and to be honest, only ways to do that is raising taxes through one way or the other. You can't really sugarcoat it, and obviously it's in a bit of a tricky place as well, because inflation is still high in the UK. There's still right, there's people still struggling, especially coming into the winter with energy prices still being high. A lot of people are going to struggle, and you hear stories of people in freezing homes in the winter because they just can't afford to put their radiators on. And obviously with an increase in tax, I know a lot of these expected tax raises are targeted towards businesses. However, there are some taxes which will target the everyday person, and even a small increase in tax can be seriously very detrimental to these people who are struggling to make ends meet in this tough economic climate that a lot of people in the UK find themselves in. Um, Obviously, as I said, the government has to increase taxes, because this loophole needs to be closed sooner rather than later. And by committing to not raising income tax, VAT, or national insurance, they've put themselves in a bit of a tricky situation here, because um, if you increase the income tax, for example, that would bring in a lot of money very quickly. Um, That being said, some of the business rate reforms which align itself close to G7 norms are probably better off for the UK as a whole. That's not, a lot of these companies won't be um, they will be disappointed about it, but it won't be too different, because all the other big major economies of the world already have similar tax rates, so it won't be that different. And did you say that people leaving the UK will have to pay 10% on
20,
their 20% on their assets, was it? So
potentially.
I guess potentially, yeah. Obviously, all of this speculative. We won't know until the 26th of November when it comes out. But I guess that's one way of trying to keep millionaires from leaving the UK, because we've talked on, this topic has come up in our podcast beforehand, where I don't know if you still remember the stat, but there was like quite a lot of millionaires who leave the UK every single day.
Yeah.
Um, and
So
by,
every 11 minutes or something like that.
right, yeah, exactly. There we go. So, yeah, I mean, if you tally that across the whole year, that'll be, like thousands of people, like no, tens of thousands of people. So if you increase this proposed tax law where they would have to pay 20% of their assets, then that could incentivize these people to stay in the UK, which will be good for the economy actually. If you've got these millionaires stay in the UK and invest in the economy and build businesses, for example, that's a benefit. So I would be a fan of that, to try and keep these high net worth people in the UK. And also that will bring in a lot of tax, obviously, because people will still leave. It's not sometimes, you have to leave certain countries for specific reasons. And you know, if these people are leaving an to sell an asset's going to be quite a lot, whether that be a house or business or land or whatever it is, that is going to account to quite a lot of money. So that is a way to raise a lot of money quite quickly. Um, but apart from that, yeah, just looking at it from a person point of view, like looking at it from, as the Labour government manifesto said, working people of the UK, I think any tax rises will be a bit detrimental, especially coming up to the winter, and um, with standard of living already relatively quite low compared to other countries, and inflation being quite high compared to other European countries. I think Labour has to do a. They're walking a very tight. They're walking a very um, thin rope, um, and over a large gaping hole, and they got to be very careful, because one misstep and um, it could be very detrimental to a lot of the people that voted for them in the first place.
I wanted to add what I think to be a unique perspective on what's going on with the UK and the US just before we close out. Um, because looking at the numbers, right, like that even went against what I thought. To think that, before we went into all of the potential tax cuts, tax raises, etc., the IMF saying the UK is set to be the second fastest growing of the world's most advanced economies this year. That's kind of like quite a strong positive about the UK, which I hadn't really thought about, right? Even like the stock market's up nearly 20% this year, right? For all of the kind of slack that the Labour government get, as well as the negative growth prospects that we hear from the taxes and regulations, it's done pretty well, right? It's done better than the S&P 500, and so I think that's like quite a strong perspective we need, because despite all the rhetoric, the actual numbers are saying second fastest growing, advanced economy, strong, strong stock market growth. So those are things that need to be noticed. Something that I find quite interesting is this idea of sentiment, and I need to get back to it. But one of my friends, who's probably like a couple of years older than me, he works as a consultant at one of the big three, McKinsey, Bain, BCG. And he was messaging me, and I met another guy, and he was basically asking about, are graduates, what's the sentiment like? Are graduates able to find jobs? Are they not? Ignoring the top three and the Goldmans and stuff of the world, because they're kind of an anomaly. Are people finding jobs, right? And the response from my friend, and the response I'm going to give, is yes. People are finding it really hard to find jobs. It's incredibly over competitive. There's a tons of online, TikToks and things like that showing, people making these bots and applying to 1 million jobs and getting calls back from like 20 out of 1 million, right? Like, as much as that's more like a joke, like it's really hard. And I think that's kind of been a point that's being explored. And I think then, the upcoming 1 to 2 years, as people go from being students to like actually unemployed after a long period of time, that will be a pretty interesting cycle. And not only that, people that would normally get, jobs at the likes of the top banks and the top tech companies, a lot of those are being laid off by by AI. So we're going to see less people rising up the ranks, but also people going into other jobs. Something that I think is really interesting that isn't discussed as much is, and I've noticed this, and Luke, you may disagree, is I think there's been quite a big brain drain out of the UK. So I went to Eton College, pretty prestigious school in the UK, and 15 years ago, out of a year of about 230 kids, and it's pretty academically selective to get into Eton, about 150 of those 230 kids would go to Oxford and Cambridge, right? Very intelligent kids would get amazing grades, go and achieve and do great things. Now that number is more like 80. And so on the one hand, there's that question is the country becoming more democratized? Are they opening it up to more people? Are there just, other opportunities and smarter kids, and maybe that is a potential thing. But when my friend was literally on, he was about to apply to Oxford, he had like 4 A stars predicted. He hops on the call for the admissions call, like when they're trying to encourage people to apply, and they're like, don't worry guys, like we don't want kids from Eton, we're going to reject them. Like even as a joke, that was kind of the notion of what people were saying. And right, you can look at the numbers, Oxford and Cambridge, it's a very like small, amount of the country, and so like maybe don't apply that to the rest of the country. But I think the stat is something like there are 93% of kids in the UK that go to state schools, only 7% go to private schools, but yet in Oxford and Cambridge, there's 80% of kids are in state schools and 20% in private schools. So it's kind of like a bigger number, so they're actually trying to reduce that number over time. What ends up happening though, like despite, obviously more opportunities, it's always a good thing to have, equal opportunities, is that these people are leaving. I'm an example of that. I've gone to Duke in the US, and I would argue that 30 of the most intelligent kids, of course there's other really intelligent kids in the UK from my school, went to Harvard. 4 scholars from my school went to Duke, Harvard, Duke, Stanford, MIT, Yale, and it all have gone to the US. I was having a call with some of my other friends that even graduated from Cambridge, and all of them are also like, yeah, we just don't really see the prospects of the UK. The US is so much bigger. On the side of venture capital, same guy I was talking about earlier, Yoshi Yokokawa, who I'm going to release a podcast with, I was asking him about like the growth in Japan versus like San Francisco, what are the differences? And he was like, well, Japan's growth's pretty good, but SF isn't the center of America, it's the center of the world. The US is such a big power and there's so much growth going on there and there's so many opportunities that this mass brain drain is going out there. Why I mention the education, where the smart people are going from schools like Eton to schools in the US, why I mention that is not just, oh, that's kind of interesting, people are leaving, maybe, they should let people in or not, whatever. The thing is that as the UK continues to have more regulations, as there's a 20%, if that's announced in a couple of weeks, 20% in action, let's say in a month's time, the amount of 20% tax on wealth, the amount of people that will leave the UK that have wealth, that are starting businesses, that want to grow, to be completely like tiny, right? Like, you're going to massively diminish the idea of growth. I think there's already a problem in the UK of people are kind of discouraged from a social level to start businesses. It can seem as too much of a risk. People have less of a risk appetite. Whereas in the US, it's kind of like, go give it a go. If you fail, pick yourself up again. So we're seeing from schooling, just to kind of close out the point, schooling, many smart kids going to other countries, going to get jobs in other countries, starting businesses, people are less confident about it and going to other countries. But even if the UK is doing well right now, where will it be in 5-10 years if there is this brain drain, if we keep encouraging higher taxes and regulations? So yeah, Luke, I kind of threw a lot there, kind of my own particular story. I know you're obviously at university in the UK going to Exeter. Do you agree with my sentiment that people are leaving? Do you think there is a brain drain? Do you think the UK is kind of stopping itself a little bit with regulations and taxes? What do you make of kind of like your perspective studying in the UK? Do you think I'm painting a bleak picture that doesn't exist?
I mean, so when to go from the beginning, obviously I went to a private school as well, Millfield, which from for a long time has always sent a lot of people over to the US, not just for academics, but more for sports scholarships and that kind of stuff. So from a school perspective, I don't think much has changed there. Maybe there are more people going over, but again, it's more for the sports, not the academics. So slightly different from Eton. But I think, yeah, look, with the Oxford and Cambridge stuff, obviously, I know they are trying to get more state school kids into these universities, and And look, yeah, I guess there is an inequality if there's 80%, only 80% of people at Oxford at these universities being from state school compared to 93% of all students being from state schools. And I guess that is you got to look into what's going on in the education system instead of applying. I think you can't discriminate against the school that you go to. Obviously, it's easy to say for us. We were very privileged to go to these brilliant schools, but I think, look, obviously in a private school, you're going to have more one-on-one time with the teachers. You're going to be closer. You're going to have smaller class sizes and maybe even get a better. And then so it may lead to a better education. So that could be why that's the well, yeah, that's why people are paying the sums of money that they are to try and for their kid. These parents are paying this money to for their kids to receive a better education, right? So um, I think. I think instead of excluding these kids from going to these universities and for almost not forcing them out the country, because there are a lot of other great universities in the UK, but um, they should focus on the state school education system and look at how to get the most out of these people who are, I'm sure, are very smart. Are probably not, unfortunately didn't have the as privileged of a background as me and you did to be able to go to, be able to go to these private schools, but very smart individuals. And how can we get them to Oxford and Cambridge instead of going like no more private school? And but by doing that, it does keep better talent here. I think if it will be quite interesting to know if what the reason behind it was, because obviously Oxford and Cambridge have both come out and said we want to get more state school kids here, but if there are less private school students going into these two universities because of pure talent, and like they just happen to be that these state school students are more competitive than previous years, and therefore they got outperformed, and or whether it be because of this like a quota. But also a lot of students do come from abroad to study in the UK, same as the US as well, of course. And for universities who are all struggling quite a lot financially in the UK, if you've got someone from an international, if you've got an international student to come to universities compared to domestic, I mean, international students paying 2, 3 times more what a domestic student is, right? So if you go from financial point of view, you'd want your university to be full of international students, um, um, and that could contribute to that brain drain where there's already, obviously compared to the US, there's not as many universities just because of sheer size of the country, but there's not as many prestigious options, and and these young students from the UK might go think, actually, um, I might want to take my talents to the US, and then for a better opportunity, for less competition, um, well, not less competition, it's still very highly competitive, but and then end up working there like yourself. And obviously that's the benefit of the US. Uh, Recently with the US, they did implement that $100,000 tax on people coming over and working. However, it's still a very attractive area, and to work in somewhere like New York or San Francisco, as you're mentioning, it is a massive global. It is probably the global hubs of the world. There's no two ways around it. So it's very enticing, and I think for the UK, they if it I don't yeah they need to look at this problem and see how can we retain our best talents here to help grow the economy, help have a better future, because we don't want to be in a space where 20 years time, 10 years time, 20 years time, where a lot of our generation has sort of fickled made their way up through these big organizations to a more senior role, that actually all of our best talent are across the pond.
Yeah, I kind of have two responses to what you said with Oxford talent, but also with like regulation. I would say raise the bar, don't cut off the knees. So like if we're at a base unit of 100, instead of saying let's cut off 10 units to look after the other 90, I think let's try and take that bar to 110, 120, kind of raise the standards for everyone. And I think that's kind of like the mindset that's had in the US. So, for example, the US has kind of got an unbelievably large amount of debt at the moment, as we both discussed before. In fact, the debt repayments are getting higher than the amount that they'll spend on the US military next year. And kind of the thought around that has been with regard to what Trump's doing with the tariffs in terms of trying to implement pro-growth policies, lower taxes for companies that are in the Mag 7, for example, is very like pro-growth, trying to increase the GDP, so kind of raise the bar instead of cut off the knees. And I think that's definitely something that needs to be focused on. Like if I was in the UK, like I think I would be, how do I both help as many people as possible, of course, but how do I retain this talent, right? And I don't think through fear, like if you leave, we'll tax you a ton, is going to help. I think the more taxes, the more disincentives that are kind of put in place to start a business, the more people are like, why would I want to be in a place like that? And the other thing to think about is the people that actually run the businesses, most of the biggest businesses on the planet. Like if you were to think in your head right now as a listener, what are the 10 biggest companies in the world, right? Even like, Apple, Google, Meta, look at oil companies, Aramco, whatever they may be. These are massive multinational companies, right? So they may have people that live and work in the UK, but in terms of foreign direct investment, there's a massive decrease incentive there. If I know that if I put my money into the UK from Saudi Arabia, and there's a chance that it gets a 20% tariff on it, so and a unit of 100 base point, 100 points, whatever, that goes down to 80 automatically just by investing in there. Why the hell would I invest in there? I'd rather have a slightly increased risk. Maybe I'd invest in a slightly less developed country that might have, a variance of 5%. So maybe we can make 5% more, but also lose 5% more, because that's in terms of pure growth, but not from a tax and regulation standpoint. So I think it's something that the UK has to think about. And I actually think that, the reason I started off this whole UK point with regard to, the second, highest growing economy according to the IMF, and also, that they're actually, the stock market has done better than, we thought it would do with 20% this year. I think those are important points to look at. But I'm curious, is this this market crash that we keep talking about? Is it a when, not an if for the UK in terms of how it does? So yeah, kind of just reiterating what we talked about today. We talked about the earnings season, depreciation for AI companies over the last 3 to 4 years, the BATMMAAN indices, FMOC, Nvidia, inflation, the US-China trade deal, market changes, why I'm annoyed at Sequoia, and finishing off with the UK autumn budget. Luke, have you got any closing thoughts?
No, actually, I think you summarized it perfectly.
Well, thank you very much for coming on today, Luke. Thank you for everyone that's listening. I hope you enjoyed our discussion today. Please make sure to subscribe if you haven't already. Trying to get to 10,000 subscribers before the end of the year. We'd also love your feedback on these episodes and whether you like more focus on specific stocks, giving you trade ideas, or a more political, economic, as well as what's going on in the market conditions. Have a great week, everyone, and yeah, goodbye from Harvey, Luke, and the rest of the Personable team.